Well, good afternoon, everyone. My name is Peter Lewis, as you've just heard. I'd like to welcome you to the penultimate session at the Greenwich Economic Forum here in Hong Kong. I hope you've enjoyed the 2 days of discussion so far. In this panel, we're going to examine the evolution of China's asset and wealth management industry. The asset management industry in China is experiencing, as I'm sure you know, unprecedented growth. Assets under management reached more than $18 trillion by the end of last year. That's a tenfold increase over the last decade. And a report by McKinsey & Company estimated China's asset management industry will more than double in size to 280 trillion yuan. That's over 40 trillion US dollars by 2030. Now, at the same time, a significant portion of Chinese wealth remains held in about $39 trillion of bank deposits. These deposits are starting to be unlocked, and that's going to help accelerate the growth and maturation of this asset management industry. So to look forward and see how the asset management and wealth management industries on the mainland will evolve, I'm delighted to welcome a panel of practitioners from the industry. We have, first of all, on my left, Alvin Chua, who is the CIO of Noir International. Alvin's also an adjunct professor at Lingnan College, Sun Yat-sen University in Guangzhou. He's also a senior advisor to the Center for Financial Stability, which is a New York-based think tank, and is an expert committee member of Green Finance Forum of 60 in Shanghai, as well as an expert committee member of Lingnan Impact. Alvin started his career a long time ago on Wall Street back in 1987. So over the past 36 years, he's held various fixed income, equity capital market and asset management positions at Merrill Lynch, Lehman Brothers, Bank of America and others. We also have with us Easton Fong, sitting next to Alvin, who's Regional Head of Fund Services at Asia Maples Group. Easton has overall responsibility for the operations of the Maple Group's fund services business in Asia. He has over 20 years of professional accounting experience, including direct experience providing fund administration services to a wide range of investment funds, including single manager hedge funds, fund of hedge funds, private equity funds, and public offered Japanese retail funds. Easton is conversant with establishing funds in unit trust, corporate funds, umbrella funds, and limited partnership structures. Previously, Easton worked for Fortis Prime Fund Solutions in Asia, and before that for Ernst & Young in Hong Kong. We also have with us Harvey Liu, who is head of FOF at Fountainhead Partners. Harvey is responsible for hedge fund investments at Fountainhead, conducting a global multi-asset and strategy allocation through hedge funds. Before Fountainhead, Harvin served as a VP at Cyprus Capital for asset allocation and hedge fund investments. And prior to this, he worked as an equity analyst for Greater China Equity Long Short Fund. And that was a joint venture between CICC and Sloan Robinson. Harvey holds a master's degree in economics from Oxford University. And sad to say, I'm the daddy of the group. I started my career in the City of London in 1983. So I've accumulated about 40 years' experience of global financial markets, held CEO, senior management, head of equity trading roles at some global investment banks and brokers. And for 8 years, I was the host of Hong Kong's business and finance radio program, Money Talk, on RTHK Radio 3. And I now self-produce that program as a daily podcast. So let me start, first of all, gentlemen, with a topic that's very much in focus at the moment when we talk about China's asset management industry, and that's the overall performance of Chinese equity markets this year. I think going long Chinese equities, that was the overwhelming call among analysts heading into 2023. People were excited about Beijing's shift away from COVID zero, thought there was going to be a speedy recovery. Most strategists turned overweight. But even when the gains started to fizzle out, I think few expected the downturn to be this prolonged and this steep. The MSCI China gauge has lost close to 20% now from its January peak, lost about $1.5 trillion in value. So what has gone wrong for Chinese equities? Why have they been the world's global underperformer this year?
Okay. And thank you, Peter. Thank you for the kind introduction and opening remark. Right? Now, what went wrong? The number you quote, MSCI China, actually, as we know, MSCI China is dominated by the Hong Kong listed H share plus the US listed ADRs. The A share in China, the inclusion factor is only 20%. Right? So let's see, if you look at the MSCI China, it hit the low October 31st last year, and from October 31st last year through the end of January, yes, it recovered 52%. But since then, it has fizzled out. Right? MSCI China, as at the end of yesterday, is still minus 0.2% roughly. Right? Now, most of that, I would say that now, when we dissect the MSCI China, I would say that the A share is about almost unchanged. Well, it's probably 3 percentage points lower over the same period. Right? It's mainly due to the underperformance of Hong Kong listed H share and the ADRs. And as we know, the Hong Kong listed H and ADR, there's a lot of foreign participations, and foreigners are skeptical of China's economic recovery. Now, going into 2023, after a year of debacle in both equity and fixed income globally, now global investors who have a lot of worries, the relentless rate hikes, the runaway inflation, and then we have the global banking problem with SVB, with Credit Suisse, and so on, right? Now, a lot of people were hinging their hope on China, the China reopening story. So the optimism was there early in the year, maybe late last year, early in the year, on China to deliver the performance. And unfortunately, as we saw over the past few months, China economic recovery, now I don't want to regurgitate a whole bunch of economic data, right? Whether it's economic recovery, whether it's export, whether it's loan demand, whether it's consumer confidence, whether it's PMI, they're all below our expectation. We are disappointed. So rightfully so, the foreign investors underweighted China or exited China. Now, for the domestic investors, right now we are talking about two markets, right? Those who are domestically in China, who have not much of a choice, but only to invest in China. As you know, capital flow out of China is restricted, right? So they can only invest in A share. They can only domestic China. Domestic China, if you look at the Shanghai Stock Exchange, now it's still up a little bit, 5 percentage points for the year, which is like not significant in the bigger scheme of things in global market this year, but still nevertheless holding okay. So I would say that the disappointment is coming from the euphoria or the higher than expected expectation of COVID reopening, and then this economic recovery, which unfortunately disappointed us.
So it was an expectation issue because people were very bullish at the beginning of the year, weren't they? It's not that necessarily, or even the economy, although people are depressed about the economy, it's still growing close to 5%, but it's just not as good as people were hoping post-COVID.
Exactly. Now, from a low of October 31st last year to the end of January, a 52% recovery, that built in a lot of expectation, and the expectation was not met.
Well, I think expectation is one key factor in play. First of all, I am not investment specialist. I am fund administrator. I am operational specialist. But what I can say in terms of this topic is we have seen, been tracking our clients' performance. Because we're a fund administrator, we do the monthly NAV calculations. Yes, the market is underperforming. But the earlier pension, I think for people around, William mentioned about alpha. We actually have seen some hedge funds been performing quite well. Not everyone, it's just exception numbers. Some of them return over 30% year to date. I know I was talking during the break with one of the quant managers on the floor. Their fund returned 14% year to date. So I think this is all about alternative investment. That's the whole purpose of why we are all here. If we are doing, saying, long only one market equity, yes, we probably underperform by 20% or more. But if we're talking about alternative investment, everybody have an opportunity. We will talk more about this, and then we'll touch more about the fund administration later on.
Well, thank you. I think if we take one step back, look at the whole pictures. First is China is the second biggest economy, and its demand and the supply creates lots of opportunities. That's why we still today sitting here and talk about the potential opportunities. And second, about the U.S. and the China relation, personally, I think it's unlikely to back to before. So we have to accept the fact, which is not bad. Actually, it's gradually when the cycles of the economy and the market is becoming more and more separated and more independent from the allocation purpose is more helpful. So come back to Peter's question, what is going wrong? I think of two guests already, just one expectation. People expect strong economy rebound, expect strong policy support, but it didn't happen. I would say it's but at the same time, we have to say that the economy is recovering slowly from the data like parcel delivery, power consumption, and transportation. All the data is supporting, it's becoming better. But I know some hedge fund, because I'm in charge of hedge fund investments, I see some hedge fund managers, they want to get back fast because they suffered 2 years. So they bet very big, 30%, 40% on a single stock and the TMT, internet. So all of this, just whenever the geopolitical tension happens, they got a bigger loss. But I think for the fundamental wise, it's becoming better. And also about the geopolitical risk, definitely created big outflow. As Easton mentioned, it's a big outflow. People just sell. Personally, very interesting observations. I have a friend used to work in CPPIB, and 2 years ago he went to Middle East to work at the sovereign family office in charge of public market investments. He said, "Well, in CPPIB, what I can do is really limited, but in Middle East, we love China." And lots of they're looking for opportunities. You can see the big difference. The point I want to mention is that very interesting. In China, people describe relation between U.S. and China as couples. So when a couple divorce, I think more people will not try to get your ex back, but rather look for a new one. So the focus is not like, whether the U.S. and China will back to the honeymoon again. Maybe it's to look at what China's replacement, what new partners in terms of trade, in terms of capital flow, which part where they put the effort on the rest of the world.
And you mentioned foreign investors. Where do foreign investors fit into the picture? Because they're now heavily underweight on China. They were big sellers in the final quarter. And they've got other places to go now, haven't they? Because last year, really, foreign investors had to be in China, but now Japan is performing for the first time in 30 years, South Korea, Taiwan, you've got India almost at new all-time highs. There are alternatives. So what is it that's going to persuade those foreign investors to come back and take another look? What's the catalyst likely to be?
Okay, you touch on the key word now, the alternative, right? Foreign investors investing globally by choice. They have the choice, and it's a matter of asset allocation. Imagine yourself as running a fund, investing in an equity fund, now benchmark to MSCI EM, and you are sitting in London, sitting in New York, right? And you have the whole world to invest in, and you can even cross over to some developed markets. Now, you ask yourself, why do I want to invest in China? The performance have disappointed us, right? Now, if you close your eye and just put your money, dump your money into NASDAQ, you deliver 30% return. NASDAQ 100, you get higher, 36%, right? And even as you mentioned, Peter, right? Now, Nikkei 225, as of yesterday, delivered 28% return. MSCI Europe, 8.5% return. China, no return, right? Now, you look at global investors, let's see benchmark to MSCI EM. China's weight in MSCI EM peaked in October 2020 at a little bit higher than 43%. A year later, it fell by 8.5%. Another year later, end of last year, it dropped to 32%, 11 percentage point decline. By the end of last month, it was 29% weighting. from 43% to 29%. There's a huge decline in weighting. And I would say that the whole world investment community currently is underweighted China. And yes, the correct word, but the buzzword is the catalyst. What was the catalyst? The confidence. Having been an investor myself, global investor myself, I would say one word, right? Now, if there's money to be made, investor will come. If there's no return expectation, everybody stay away. So when is the chance that we'll see sustainable recovery in Chinese equity and the whole investor will come back? Also, we look at domestic investors, like the number you threw out just now, the excess savings in China, the bank deposit in China, somewhere around like 2.6 trillion equivalent, right? Okay, and as you know, the government is lowering interest rate, lowering deposit rate. And at one point, they will come to a tipping point. If you are sitting on millions of deposit in the bank in China, you're Chinese domestic residents, and if the deposit rate had gone from, let's say, 3-month deposit right now, 1.3, 1.4% to 0.5%, how about 0.3%? What are you going to do with your money? And you look at the Shanghai Stock Exchange, right? The dividend yield is about, I think, 2.7, 2.8%. You might as well invest your money in, and you can reasonably easily construct a portfolio of higher dividend yield with very stable cash flow, company with stable cash flow, large SOEs, right? And which you can easily get 5 to 6% dividend yield. Why do you want to put your money in the bank for 0.5%? I believe the tipping point will come, and tipping point plus all the government policies being discussed right now to rejuvenate the economic growth, right? The stimulus, the public spending, right? All the other initiative on public investment and so on. So at one point, now it may not be immediately, given it's test and try, but at one point we'll come to the tipping point, and we'll see the inflow. And when we and human nature always, like, you buy on gains, you don't buy on dips. And there is a catchword there. Well, I mean, yeah, valuation could be low, but valuation can stay low for a long period of time. And if you are a fund manager, you get stuck with the equity, get trapped in the value trap. You have monthly, quarterly, annual performance. You may invest in a stock. We can invest in a stock, and if it sit there, doesn't change for 2 years, we are fine. But as a fund manager, it's a career risk to invest in a stock that get trapped in the value trap, right? But individually, I think dividend yield play using a fixed income approach to invest in the equity while you buy time for the recovery, I think is a good choice.
Okay. Do you think, Easton and Harvey, do you think foreign investors are re-evaluating the risks of China? Because they've got a lot of things to worry about at the moment, haven't they? There's the geopolitical risks. We've seen the regulatory crackdown, which has hit the technology sector hard. It wiped out the whole online education sector virtually overnight. We've got the economic concerns as well. Has there been a fundamental re-evaluation of the risks?
I was in Beijing and Shanghai 3 weeks ago visiting our clients. Our clients primarily PE/VC space, and some of them have branches or offices in Hong Kong, so they run hedge funds. So one consistent theme for those who have institutional pensions investors, so they're all preparing themselves to meet their investors in China because they're coming to China and they are preparing to tell the China story. So that's very consistent. They've all been thinking about what the story to tell their clients because they come to see themselves. Some are very confident, not like in a panic mode. Oh, so shit, this is not going to give them a good picture. So most of our clients are very calm, and they still thinking that China is an investable place for their investors. But having said that, they do express that some of the investors, LPs, been sort of putting, I wouldn't say a pause, but just a wait and see approach. But more of the existing LPs coming from, we mentioned about Middle East, Southeast Asia, are more willing to still consider the opportunities. So from that trips, we came home with 3 new funds. Not all blind pool PE VC fund that we want, but it's more like a single projects. They said the Middle Eastern investors is going to allocate X amount of money into certain identified projects. That's a good sign. At least that means there's still people willing to invest in China, and perhaps to Harvey's point, the relationship in Southeast Asia as well. So as a fund administrator, we like to see more funds. Like we like to hear about our clients telling us about the tipping point. So hopefully that means more when the tipping point happens, there'll be more products coming our way. Thank you, Noah. So we all are ready ourselves to really making sure we're ready for that volume business coming back. We want to continue to do a good job in streamlining all our operational efficiency to just make sure that opportunity will capture again when it comes back.
Thank you, Easton. I totally agree with you. I think it's a de-rating process in terms of if you look at after Crimea 2014, the Russian stock trading at a much bigger discount versus the U.S. stocks. It has been there for long. So, this might not be a good example, but it shows you what I mean. Maybe the discount has been there for long. And second, if you look at return on capital, probably it's not that attractive as before as well. If you promote manufacturing industry, the business model itself generally have a lower margin than the consumer internet. So you talk about the de-rating. I would say it's like a rebalance process. When you give all the facts, how will you allocate how much you want to allocate into China? Probably it's just the rebalance when the new equilibrium reached, and then people will stay there and rebalance given that point. But having said that, come back to the first topic I mentioned. It's still really good opportunities given the lower valuation and lower ROE, and people, if some business still attractive, still have a growth, then it's a point to invest into.
Okay. Let me turn our attentions a little bit to Chinese families and the framework of asset allocation for families. As I mentioned earlier, there's $39 trillion of bank deposits in China. That went up by 2.6 trillion just last year alone because consumer spending got crushed, so people started saving and accumulating cash a lot more. What needs to be done to persuade Chinese households to deploy those savings into the market, and what sort of investment products do they need?
Okay, there is an enormous pool, and I look at it as an opportunity as well. It's dry powder, right? And the savers need confidence. And number one confidence is my job, my paycheck. If my paycheck keep coming, then I do not need to save so much money in the bank. And with such a low deposit rate, I do not need to save the money in the bank. So first and foremost is the return of confidence, the public confidence. And that's been worked on, right? Actually just offline, right? My advice to several policymakers, and one of them is he spent a few years at the Kennedy School of Business, so at Kennedy School of Politics, and my joke with him is that you need to rebuild confidence. Confidence, now this is for elderly gentlemen, right? Confidence, unlike virginity, can be rebuilt, but it needs time, and you need to be consistent with it. Right? Once the confidence is there, then consumer spending comes naturally, and that grows the economy. Right? Right now, we are not there yet, but I look at the 39 trillion as enormous dry powder, and you just need to rekindle the animal spirit. And China, when it comes to equity market, comes to investment, this enormous this animal spirit, right? Right now, I just came back from Shanghai last night. Right? Right now, a lot of investors are at a loss. What do we do? Right? Now, when they look at the global investment return and they're salivating with the NASDAQ, salivating with the Nikkei 225, there's nothing they can do about it because they cannot convert to foreign currency. Investing locally, the local equity market, Asia and China, going nowhere. Putting money in the bank, just looking at the deposit rate going lower. But there is nothing much you can do about it. And right now, you just wait and being frustrated with the waiting and wait and wait. So I think the policymaker is rightfully to step in with a lot of policy initiative, including, my another advice to policymaker is, you look at America in 2008, how did they recover? The equity market been devastated. The S&P dropped 56% from peak to drought. How did it recover? 0 interest rate, 7 years of 0 interest rate. How did it recover in 2020 with a pandemic hit? Right? Now, S&P dropped 33% in 4 weeks, 0 interest rate. China is no capacity to print money or to hand out money. But yes, 0 interest rate, lowering interest rate. At some point, there will be the tipping point effect.
Yeah, I like that tipping point. So I might just share slightly different, but I think it's related, is about employment. I think one of the keynote speakers mentioned earlier, the fresh graduates employment rate is just about 20%. I wanted to share with you what I understand the real situation. In the first tier city, like the Beijing, Shanghai, that's probably the truth. The reason for that is obviously the parents, a lot of experts here in the room will know about this, would not like them to move into blue collar work. They rather them go back to do a master degree or stay at home for 2 years until the economy recover. So this becomes a vicious cycle itself, because you graduates in 2 years' time from your master degree, you see all your peers, they also graduates with a master degree. And plus the fresh graduates from the uni, and plus those who did not go to do a master degree but had retained 2 years, earned 2 years of working experience. But a different picture, this is what I wanted to share with you, because I involved myself in some charity work in China for over 10 years. The tertiary and some underprivileged cities, the unemployment rate for those fresh college graduates is 100%, because they're willing to go into blue collar. It's not going to the financial service industry, because they need to repay their loans, because they need to support their families. It's just because of that. Because one of my friends, they just come back and share the story. So I wanted to say this is probably a more structural things. I'll leave it to the economists to handle policymakers to make suggestions. But a slightly different picture there.
I had a guest on Money Talk this morning. He said the number one issue that China has to solve is that record high youth unemployment rate. It just contaminates everything. Harvey, what do you think? What needs to be done to persuade these households to start putting the money into markets, into investment products?
Well, the question is, why do they need to put money into the markets? In the US, the core asset is SP 500. This accumulates all the wealth of people. In China, it's worth real estate. So the point why people put money there in China is because it gives people the perception of a long-term, continuously compounding functions and capital preservation. So as Alvin mentioned, if you don't give people the confidence, you can't just persuade them to put money into the equity market. So what they should do, probably they should do nothing. They did too much, I think. That's a problem. And the second, of course, as to my friends mentioned, it takes time gradually to solve the issue, to get back the confidence. But some maybe faster way, they can just let people to have easier access to the Hong Kong market. there's lots of really good companies listed here, and they have the compounding effect, compounding opportunity. And it's a mutual benefit. The markets benefit and the people benefit. So yeah, that's my, yeah.
But is there also an issue of, as well as confidence, you want people to feel confident, to be able to start putting money into the markets again. They also need product as well, don't they? They need the right product to encourage them, to entice them. And there's a bit of a lack of that product at the moment, isn't there? What sort of products, you design products, Harvey, what sort of products do you think would help do that?
China is for the product wise, yes, it's not that very well developed, but it goes quite fast. We see CB market becoming bigger very fast, and structured products, derivatives, and even for Chinese, Malta is a good product to accumulate wealth, and gold. You can do all of this. So for retail people, I think stock will be good enough. Just access to the opportunities, I think is more important.
And what about the pension side? Obviously, that's going to evolve as well. We're going to see a big expansion in pension needs. Financial companies are going to have to upgrade their products and services. How are you looking to capture the growth from pension reform on the mainland?
The pension reform. Could you give me? Maybe Alvin or Easton. Could you give us a little bit more color about that part?
It would take a lot of time. The pension market in China is very small relative to the GDP, relative to the population. Pension assets as percentage of GDP in China is lowest, one of the lowest in the OECD countries. And the pension reform would not come fast enough to give any boost to the financial market in the next 3 to 5 years.
Mm-hmm. But that's where there's going to be some opportunity, isn't there?
Yes, there was more opportunities, but no, we can't wait. I don't know. Some of us can wait 3 to 5 years for opportunities. You and I, Harvey, maybe Peter, we don't have that many 5 years to wait.
Thanks. Thanks for reminding me.
You and I mean, including me.
I think we're going to wrap up this panel quickly. Easton, let me turn to your area, funds administration. China's asset and wealth management industry, it's been in existence now, for 2 decades or so. It's experienced rapid growth compared to other markets. China has an appetite for US dollar products. They want to gain international exposure. Many China-based fund managers have been setting up in Hong Kong to try and meet that demand. What sort of challenges is that posing?
Sure. Thank you for that question. Finally, I got a topic I can speak on. So the China's asset management and the wealth market or industry has been developing for over 2 decades, as most of us knows. It has grown very rapidly. It grows to a point where it's no longer the domestic the products or the QD products that access the offshore is sufficient to satisfy the demand, where the general partners and the managers are being asked or encouraged to set up offshores for some US dollar product, obviously to gain US dollar exposure as well as international exposures. So what we have seen over the last 15 years in Asia, our firm's been here for over 25 years, so we really have witnessed the growth of the industry with the capital markets in China opening up. The first thing they come to Hong Kong, set up in Hong Kong, is the shocks that they, obviously they bring with their experience, the onshore domestic experience. They have, they understood the counterparty they work with is custodian bank. If they trade A shares, and then the custodian bank will do all the settlement, the valuations, and the reporting for them, and that's all they need. But coming to Hong Kong, the first thing they understand is, well, there's a license they need to obtain with SFC, so they need to speak to someone who can help them with that licensing process. The next step is they need to consider setting up a product, which usually is investment funds. Unless they are a family office, they may go through a different stage. Then when it comes to investment fund, they need to consider to select a jurisdiction that will fit for their investors, and also a structure. So they would need to speak to the professionals like the onshore legal counsel, offshore legal counsel, and all the service provider. Like if they are hedge fund, they need to speak to the prime broker. They need to speak to, obviously, fund administrator, auditor, and then the system technology provider. I was here yesterday, so there was some technology they need to consider the OMS, PMS, or if you're a quant manager, obviously, I understand most of you will be relying on your proprietary system because it's a very different play. But again, they need to go round and round and speak to the people in the ecosystem in order to decide who they work with and what sort of product they can come up with before they go roadshow and start raising that capital. So I guess the question, well, the way that I see Hong Kong, to your question about what Hong Kong can do for them. Hong Kong, as we all live here, we probably take it for granted that everything seems to be working very well. The public transportation is super reliable. Other than the real estate, which is quite expensive, the other things, the cost of living is relatively, comparatively, affordable. And then a lot of things actually works and almost to its optimum efficiency. So we take that all for granted. We also take for granted, like we have a robust legal, regulatory compliance system because we grew up here and we kind of get used to it. But when it comes, from, onshore to offshore, it's a different feel and look. They need to go through as I mentioned, the proper licensing. They need to understand, when the East meets the West in Hong Kong, it's the melting pot for where exactly that cultural and diversity and inclusive, and also the talent pool, and all those is in one single place, offering that solutions, that help, that people may just take it for granted. But that's not, I would say that's not something we should take it for granted. Obviously, we have faced challenges during COVID, but the government, has rolled out like the new scheme in trying to attract talent, back to Hong Kong, and we have seen some application coming in for jobs. That's very encouraging. So with all that's built in the background and it's a foundation that helps the industry to build in a healthy way that's sustainable, but also at the end of the day, it's the international investor, as I think we all have mentioned. You go direct to China, it's not possible because of the cross-border and then the structure, but coming to Hong Kong is where, they understand about the common law, they understand about investor protection, they understand the track record of the regulator. They have weathered through all the AFC, the Asian financial crisis, 1997. I was there. The GFC, 2008. The SARS, 2003. Of course, the fresh memory. You all know that the COVID. So these all proven track records helps. The investors and all the whole ecosystem, I call it, in operating efficiently within this place and offer the best they can contribute to the industry, which brings benefits to Hong Kong.
You've listed a lot of good things that Hong Kong has as a global asset management hub, helping those managers.
Yep.
Look, we've got about 3 minutes left, so let me give you a chance to ask any questions as well of the panel before we finish. Does anyone want to ask any questions? If not, I will ask one, an issue that's close to my heart. Are you having to pay more attention to sustainable investments these days?
Absolutely, yes. It's in every one of us, our self-interest to look into sustainability, or in the overall acronym called ESG. Right? Now, if you dissect the numbers, now one of the things we find out that why is it that the oil company that print money, minting money from the sky, are commanding such a low valuation? various technology, techs command such a high valuation and market cap because tech is being bundled into sustainability, and oil is not bundled into sustainability. So, I mean, sustainability will be with us for a long time to come. Renewable energy, green energy will be with us. And you look at the temperature outside, now it reminded us that we need sustainable, we need renewable energy.
Harvey, how are you considering this at your firm? Is it a big issue?
It is. We gradually, I think F2C is really a process. At the very beginning, I'm a little bit suspicious about the concept. That was many years ago, because my job is to pursue return. If I take responsibilities, I can go charity by myself. I have to confess, that's the very beginning what I'm thinking about. And gradually, just more and more people, I think it's really a community thing. More and more people start to talk about this and get more understanding. And I think the sustainable issue becoming sustainable itself already now. As Alvin mentioned, we can see the opportunities, investment opportunities from all of these changes. And all of these changes is really helpful to human being as a whole. So we do participate and give weight when we evaluate investments, and which is consistent with the fund managers we invest into as well.
If you go back 10 years, the person who would be responsible for sustainable investments at a fund management firm would be sitting in the far corner of the office on their own, whereas now it's a big area, isn't it? It's a major part of every fund management firm, wealth management firm.
Yeah, as administrator, we are getting ourselves ready for the reporting support to the ESG reporting and certifications. We operate globally in not just Asia. We have footprint in Europe. Europe, ESG is a very big thing. There are regulations. They're setting up funds, Article 8, Article 9 funds that's follow a set of strict rules for ESG. So they need people to provide certification on ESG and reporting on ESG. As a service provider, you need to think about whether you build a solution from scratch or you partner with somebody who are specialists in the areas. That's when Maples have chosen the second route to partner with somebody. So we need to get ourselves ready to support our clients, our managers in the industry to promote the best practices. Sustainability is a big theme.
Okay, well, we've hit the zero right on the dot there. Very good. Thank you very much for keeping good time there. And I'm afraid we have run out of time. So thank you very much to our panelists, Alvin Chua, the CEO of Noir International Wealth Management, Harvey Liu, Head of FOF at Fountainhead Partners, Easton Fong, Regional Head of Fund Services at Asia Maples Group. And thank you very much for coming along. Enjoy the rest of your day.